Hi guys, and welcome to another video. Anthony here to teach you everything about finance and personal finance. As investors, we're all becoming more aware of our place in the world. We appreciate that businesses need to make money, but in doing so, we want to make sure that they're not ruining the planet for our next generation. We understand that climate change is real. We understand that we want to give back to communities, and up to 75% of all investors appreciate that businesses need to make money, but they should do good at the same time. And I've seen this firsthand when speaking to younger generations. I've done a couple of talks to secondary schools and I've seen how 14, 15 and 16-year-olds react to companies which I show them. They question, are they really good companies and are there better companies in which you can invest in ethically? And that raises a good question. How can we as investors invest our money ethically? Well, there seems to be a buzzword going around right now, and as we've seen in the last year, there's been huge inflows into funds which ethically invest, and these are called ESG funds. But are they all they're cracked up to be? And are they the best way for investors to invest ethically? First of all, let's look at what ESG stands for. ESG stands for environment, social, and governance. And these are three key criteria to ensure that any company does good for the world. Environment isn't just climate change, it's looking at pollution, because you don't want someone just to create chemicals and pour them into rivers, looking at water quality and also recycling. Social is looking at the rights of people in society. It starts with their employees, paying employees fairly, then moving out to the public and what it does in a community. It also looks at the diversity of that company and its public stance on social issues. And finally is the governance of a company, and this really goes down to how the company is run. You don't want a company where the CEO is jetting across the world and using money from the company to enrich themselves without benefiting shareholders and employees. And this just means that the governance of the company is in line with shareholders' values. This means the company has strong ethics on their executive pay and the diversity of their board, such as the number of women that they have on the board. All of these three topics are to make a company better for not only shareholders, but better businesses for society as a whole. And one easy way to be better for society as a whole is smashing that like button. And each of these aspects are important in their own right. The environment is important as we can't just keep digging up dinosaurs and burning them for the rest of our lives. And social is important as you want to make sure that companies that are making money aren't doing it at the detriment to their local area. You want to ensure that when they employ people, that those people are being well paid. And governance is extremely important. You don't want senior officials to abuse their positions of power, that they can just make themselves rich at the detriment to absolutely everyone else, just taking money quite literally out of the till. Now, I don't know about you, but that sounds pretty important to me. You don't want to live in a world which, we go back to Victorian times when we're like Oliver Twist, begging for some money. I know that there can be lots of different aspects which we have to bear in mind. Well, let's discuss some of the positives and also some of the negatives of investing into ESG companies. Firstly, some of the positives, because believe me, it sounds great. Who wouldn't want to invest into companies which have strong environmental aspects, social aspects, and strong governance? One thing which is great about ESG companies is they've tended to outperform traditional companies. ESG funds have tended to outperform managed funds that don't specifically aim for ESG companies. And there's two reasons for this. ESG companies on the whole are probably better managed because they're actually aware of how they're governed. They probably want to be governed better. They want a diverse board. They want to pay employees well. If you have a diverse board, it means that they're looking out for shareholder value. If you pay employees well, then they're more likely to work harder, put more hours in, create more profit, because they feel rewarded. Another reason why high ESG funds perform particularly well is because of their weighting. ESG funds tend to be weighted heavily into the tech sector, and as we know, over the last 10 years, the tech sector has performed incredibly well. Compare that to the weighting which they'll be particularly low on. They'll be particularly low on the oil and gas sector because, as you know, burning dead dinosaurs isn't exactly great for the environment. And over the past 10 years, oil and gas companies haven't performed particularly well on the stock market. So that sounds great. Where do I sign up? Why shouldn't we invest into ESG funds and focus on companies which have a high ESG rating? Well, to be quite honest, it's not that easy. First of all, there's no clear ESG rating for all companies. As we've seen some companies perform particularly well in the green aspect. they're moving away from fossil fuels, they're moving to green energy and want to include green energy into their supply chain. However, they might not pay their employees particularly high wages. And as a result of this disconnect between some companies doing certain aspects of ESG really well, but then trying to sweep the bad aspects under the carpet and pretend that they never happened. Because of that, there's been this term called greenwashing, where a company will put out good PR to show that it's performing highly in the ESG ratings, whereas in reality they'll be doing other things which aren't particularly high in the ESG standards. Now, as there's not one clear definition for ESG, it means that some funds and some companies and some investment managers kind of make it up as they go along. But having one central regulated directive is going to be key. That's good for investors because at the moment it's a bit of a minefield when you come to invest into ESG funds. You don't know exactly how they're weighting different companies and what aspects they're specifically looking at, unless you do a lot of research and a lot of reading around exactly what funds you're going to buy. So picking a company or fund that does all round good is particularly hard because, as we know, one company can do well in one aspect but not do quite so well in another aspect. So the only real way to invest into companies which have high ESG scores or into funds which have high ESG companies in them is to do more research. However, if you are interested in investing into an ethical way, then check out the link in my description below. I put a link to an investment manager called Nutmeg. They do everything online. They invest into ETFs and they can provide you with a diversified portfolio so that you can keep adding your money in each and every month. One thing which Nutmeg really highlights is how your portfolio scores on ESG rankings. And as you can see, Nutmeg have a management style which has a higher degree of social responsibility. So if you are interested in investing in a socially responsible way, then definitely check out the link in my description below. And if you are interested in investing into individual companies and happy to do your own research into the way in which those companies will perform on an ESG basis, then check out my link for Trading 212. If you use that link, you will also get one free share up to £100. And if you have enjoyed today's video, please hit that like button. If you want to see more videos from a finance professional talking about personal finance, finance and investing, then hit that subscribe button. And I'll see you next time.